Thank you for choosing this course and for setting aside the time to study it. This course will guide you through the process of investing during what is shaping up to be an incredibly exciting time for crypto investors. New technologies such as blockchain-based gaming, decentralized finance and NFTs will offer amazing opportunities to savvy investors over the next few years. In order to take advantage of these opportunities, investors need to start planting the seeds of growth right now. As someone who's been investing in crypto since 2013, I know just how challenging it can be. I've been through multiple bull and bear markets and have created strategies that help me to grow my investment portfolio and become a consistently profitable investor. By the time you complete this course, you will have gained a thorough understanding of the key aspects of crypto investing. You'll learn about bull and bear market cycles and how to recognize them before they happen. You'll gain key insights into the likely drivers of the next bull market. You'll learn how to use technical analysis, tokenomics, and fundamental analysis to make good investing decisions, and you'll learn all about market psychology. Most importantly, you'll learn about the best times to buy and sell, which types of altcoins to invest in, and which to avoid. And you'll learn about all the things you need to do in order to prepare for bull markets. This course is for those who are thinking about investing in cryptocurrencies between now and 2025. If you'd like to find more investment opportunities, would like to become consistently profitable, and want to know how to survive bear markets and thrive in bull markets, then this course is for you. All you need is a willingness to learn and a desire to become financially free. Feel free to check out some of the free lectures and then join us as we embark on this amazing crypto revolution. Firstly, I'd like to state that I am not a financial advisor and I do not provide financial advice. Please pause the video and read this disclaimer before proceeding with the course. What a bull market looks like. Defining a crypto bull market is not as simple as it may seem. Bull markets come in all shapes and sizes. Some are as short as a few months, others can last years. What makes things even more interesting is that you can have a short-term bull market nested within a longer-term bear market, a short-term bear market nested within a longer-term bull market. Time frame is key when defining bull markets. As we can see in this chart of Bitcoin, if we zoom out enough, we can see that it's always been in a bull market. Whilst this is true in the long term, one can't rule out the nested bear markets that occur periodically, as they usually result in 60% plus drops. Knowing how to actively invest in order to maximize profits and minimize losses is crucial for those who want to grow their portfolios. A bull market is a period in time where the price trends upwards, continuing to make higher highs and higher lows until the market tops out and starts trending downwards, marking the end of the bull market and the beginning of the bear market. In crypto, bull markets are cyclical and they last anywhere from a few months to a few years. If we look at the Bitcoin chart, we can see that bull markets occurred between 2011 to 2013, 2016 to 2018, a short one occurred during 2019, and a longer term one occurred between 2021 and 2022. During a bull market, almost every cryptocurrency goes up, and sentiment in the crypto space is extremely positive. In the early to middle stages of a bull market, good news makes prices climb even higher, and bad news has very little effect on price. Traders and investors who find themselves in a crypto bull market need to be very careful and need to constantly make sure that they don't get caught up in the hype. Sentiment can quickly change in the latter stages of a bull market when it starts running out of steam. During a late stage bull market, positive news goes into absolute overdrive. All of the talking heads on crypto YouTube and Twitter talk about how crypto will go up forever, and they come out with the most outlandish price predictions. Rational voices who point out that the market has already gone up a lot are silenced or ignored. When a bull market is in the late stages, all of this positive news does very little to pump the price even further. It's at this point that negative news can often be the pin that bursts the bubble. The current state of crypto technology in terms of its user base and ease of use is very similar to the state of the internet in the late 1990s. Crypto apps are much more user-friendly than they used to be. Wallets and exchanges are becoming more and more intuitive by the day. Despite all of the amazing improvements over the years, crypto is still very much a niche technology. The people who buy and sell crypto or use it to buy goods and services are still a relatively small proportion of the general population, as one needs a decent level of technical skill in order to secure a wallet correctly and to send the right amount of crypto to the right addresses. There are countless stories of people accidentally sending Ethereum with a ridiculously large fee due to making a mistake. Unfortunately, many people still get their crypto stolen as they store large amounts of crypto on app wallets on their phones, which is a far less secure way to store crypto than hardware wallets, which are the gold standard when it comes to crypto security. The internet of the 1990s was just like crypto is today. Back then, using the internet was a very niche activity that only computer geeks and academics engaged in. The primitive, expensive, and unintuitive technology created a huge barrier to entry, as only the most technically skilled and committed users could use the early internet, as even the process of getting online required an expensive modem that needed a high level of skill to correctly configure. People couldn't just buy a device, connect to their Wi-Fi, and then start watching funny videos in 5 minutes. Getting online in the 1990s required users to read hefty instruction manuals and spend hours getting their modem to work with their new computer. Just like the world of crypto, there were many scams that early internet users fell victim to. Unsuspecting victims would carelessly email their credit card details to fraudsters or enter them into fraudulent websites only to find themselves out of pocket. Like 1990s internet, crypto is in the high growth phase of development. The possibilities are endless as people think up new ways to use this new technology. This drives a wave of adoption, which in turn attracts investors who seek to profit from the growth of this new technology. The technology and ecosystems that power crypto have advanced to the point that it's slowly becoming easy enough for the average Joe to use, and there's growing interest in the importance of crypto. This interest is helped in large part by the recessionary economic environments that we find ourselves in at the moment. People are sick and tired of seeing their hard-earned savings buy them less and less. People are tired of seeing real wages fall year by year because of the corrosive impact of inflation. Inflation is a key factor that's driving the adoption of deflationary cryptocurrencies like Bitcoin. Another key factor is financial autonomy and inclusion. DeFi allows anyone to lend or borrow regardless of their credit status or perceived worthiness. This is something that's very appealing to people who may not be able to access these financial services within the banking system. Crypto gaming will be a big driver of mass adoption in the years to come, as it will create novel opportunities when it comes to things like in-game assets. In most Web 2 games, users have very little control over the assets they acquire in games, whether those assets are won or purchased. There are limited options when it comes to asset customization, and players can't move assets from one game to another. This can be very frustrating for players, as they may have spent hundreds of hours acquiring in-game assets, only to find that these assets are locked in a walled garden. Web3 powered crypto gaming changes all of this and allows players to have complete control over their in-game assets. They will be able to modify them, move them from game to game, sell them to other players, or even destroy them if they choose. Crypto is on the verge of mass adoption because people are seeking more autonomy and independence, both in the real world and the digital. Deflationary cryptocurrencies, DeFi and decentralized crypto games, and metaverses will be a big part of this movement towards greater decentralization. The big shift in internet technology that's happening right now is the transition to Web3. To understand what Web3 is, we need to look at how the internet has evolved over time. Web 1. Web 1 can be described as the first iteration of the internet, and it existed between 1990 to 2004. During this time, the internet consisted of websites that didn't change much. Information was read-only, and it mostly flowed one way, from large companies and institutions to users. Web 2.0. Between 2004 to the present day, the internet became much more interactive as it evolved from a read-only model to a read-write model. With the advent of social media platforms in 2004, people began to share user-generated content from one user to another, and these interactions grew exponentially as more people came online. As social media became one of the major use cases of the internet, a small handful of corporations began to control the majority of this traffic, and they started to monetize the attention of their users with ads. The increased control that tech companies exerted stifled the freedom and creativity of the users, who are the very people that brought value to these platforms in the first place. Users' ideas became increasingly censored if they were politically incorrect or not advertiser-friendly, and the users had no ownership over their creations on these platforms, which turned into walled gardens. Users could have their content deleted on a whim, and they could be banned from these platforms at a moment's notice. Web 3.0. Web 3 is a term that describes a new, better internet that is decentralized and fair for all the users. Some of the core technologies of Web 3 are blockchains, NFTs, and cryptocurrencies, technologies that are decentralized and give back control to the users. This decentralization makes Web 3 permissionless, as users do not need the permission of some big tech company to create or access content. This is instead governed by smart contracts as well as the voting power of the community. Web 3 is trustless. Users no longer have to trust that a company will have their best interests at heart. Web 3 is powered by cryptocurrency. This is a big deal for us in the crypto space, as the cryptocurrencies and ecosystems that power this new internet will eventually be used by millions, if not billions, of users. As Web 3 is crypto native, this will grant users much needed ownership rights over digital content. Users will demand the ability to freely move and trade their hard-earned in-game assets from game to game or to any NFT marketplace that they wish. Game companies that don't comply will become increasingly irrelevant as people move to platforms that enable freedom and digital ownership. Some interesting Web3 crypto applications are decentralized exchanges, NFT marketplaces, and blockchain-based games that allow users to trade in-game assets. One interesting project to keep an eye on is Uniswap, the NFT marketplace that aims to be the Uniswap of NFTs, which will make the process of trading digital art much easier and quicker. We are still very early in the development of Web3, but the growth of Web3 crypto applications shows no signs of stopping. During each and every bull market, one thing that I've noticed is that people always say the same ridiculous things. Here are some examples. This bull market will be the biggest bull market ever. This bull market will be a super cycle. This is the vertical stage of the S-curve adoption. X country, company, or organization is about to start using this crypto. When that happens, there will never be a bear market again. Crypto is going mainstream. It's only up from here. These are all variations of the "this time is different" mentality, where deluded investors believe that they are in just the right time and place in history where the market will do something that they have never done before. I fell for this mentality when I first started investing in crypto, and it prevented me from being able to take advantage of the low prices during the subsequent bear market. Any time you encounter someone with a "this time is different" mentality, you should ask yourself, is it more likely that the market will behave in a way that's completely abnormal, where the bull market goes on forever? Or is it more likely that this market will behave similarly to previous bull markets and that the bull market will eventually come to an end. If we look at a chart of Bitcoin, the longest running cryptocurrency, we can see for the entirety of its existence, it has closely followed a 4-year cycle, where Bitcoin will spend 2 years in a bull market and 2 years in a bear market. These 4-year boom and bust cycles are a side effect of Bitcoin's halving cycle, where the amount of new Bitcoins issued every 10 minutes is cut in half. This event happens roughly every 4 years. Different altcoins have different halving cycles. Many don't have a halving cycle at all, and have other mechanisms that control the supply of coins in circulation. Despite this, every altcoin is affected by the Bitcoin halving cycle. Bitcoin still runs the show, and the entire crypto market continues to follow Bitcoin's lead. When Bitcoin goes up, altcoins go up even higher. When Bitcoin goes down, altcoins drop even lower. This could change in the future as altcoins gain wider share and market influence, but for now at least, the Bitcoin halving cycle has a very big impact on the movement of the entire crypto space, as well as the timing of bull and bear markets. As the saying goes, history doesn't repeat itself, but it often rhymes. This is also true for crypto. If we look at the Bitcoin chart, we can see that it moves with startling regularity. In 2015, Bitcoin made its cycle low. It then took another 1,428 days, which is just under 4 years, before Bitcoin made a new cycle low on December 10, 2018. We can see that a similar thing happens for Bitcoin tops, which have so far been just over 4 years apart. Bitcoin broke the 4-figure level for the first time ever in November 2013. Then, just over 4 years later, it hit 19.6k in December 2017. Then, just under 4 years later, it made yet another all-time high of 69k during November of 2021. If this 4-year cycle continues, we could expect to see a new all-time high occur around the second half of 2025. Whilst the 4-year cycle does give us an idea of when we can expect the next crypto bull market to begin, we have to keep in mind that each cycle is different from the last. We need look no further than the crypto bull market of 2021 to see clear evidence of this. In 2021, many crypto pundits were expecting Bitcoin to break past the 6-figure level. I have to admit that I also thought that this would be a possibility. It seemed like 100k plus Bitcoin would be the logical next step for the Bitcoin price. As we all know, Bitcoin didn't quite make it and fell short of everyone's expectations. As traders and investors, we can't just focus on the charts alone. Crypto does not exist in a vacuum. It's affected by many different macroeconomic factors. During 2021, the world was still in the midst of a pandemic, and the economy was still recovering from the unprecedented impact that this once-in-a-century event had on the world. As much as we in the crypto space would love for crypto to become decoupled from external factors, crypto is not immune to pandemics, and it's certainly not immune to macroeconomics. Knowing this will help us to be flexible so that we can treat each and every bull market as a unique event instead of thinking it will be a copy and paste repeat of the previous bull market. Treating each bull market as a unique event will help traders and investors to recognize and take advantage of the unique opportunities that will be made available. Many investors who thought that 2021's bull market would be a repeat of the 2017 bull market would have had to endure the loss of most of their profits, as crypto didn't go up anywhere near as much as was expected. Those who bought the best performers of 2018, thinking they would do just as well in 2021, would have missed out on the boom in rebasing DAOs, metaverse tokens, and meme coins, whilst their bag of last season's altcoins barely moved at all. It's still too early to know which coins will do well in the future, but by keeping an eye on developments in crypto, as well as altcoin categories that start gaining traction during the bear market, we can get a good idea about the categories that will outperform all others during the next crypto bull market. The previous crypto bull market was quite unlike the others that came before it. In 2017, the market trended upwards at the beginning of the bull market, then culminated in a spectacular parabolic blow-off top at the end of the bull market in January 2018. The 2013 bull market was characterized by what many describe as a double bubble, where the price started at $13 at the beginning of the year and then rallied up to $258 by April. The rise was partly fueled by the Cyprus banking crisis, where customers had strict limits imposed on withdrawals. This led many to view Bitcoin as a safe haven from banks and governments. The price then suffered a dramatic crash, falling 82% in the space of a few weeks, before going on to make a new bubble as Bitcoin rose 2,400% between April 2013 and November 2013. The 2021 bull market was quite underwhelming in comparison. It started the year at 29k and then rose 124% up to 61k. This rise was a far cry from the smooth and sustained uptrend that we were used to in crypto. Instead, it was a bumpy and slow pump that reached a peak in April 2021. The price then crashed 55%. Many attributed the fall to Elon Musk, who stated that Tesla would no longer accept Bitcoin as a payment method due to its energy usage. This was quite a shock to the crypto community, as Elon was seen as a Bitcoin evangelist just a few months earlier due to putting Bitcoin on Tesla's balance sheets. Some thought that the bull market was over, others thought that we would get a repeat of 2013's double bubble. Bitcoin then languished in the 30k region for a few months before rising up again to a new all-time high of 69k. It was a double bubble of sorts, but it was a far cry from the 2013 double bubble, where the second peak was 351% higher than the first peak. To put it into perspective, if the same thing happened in 2021 as many were expecting, Bitcoin would have topped out at around 275k instead of a measly 69k. This price action confused the vast majority of people in the crypto space. Even long-term crypto veterans expected more, and almost everyone held out for much higher prices, only to be disappointed as the higher prices didn't come, as the bull market had ended and the bear market was just beginning. During this bull market, the term wick-off became widespread in the crypto community for the first time ever. A wick-off pattern is a type of chart formation that features a wide-ranging sideways market that is quite frustrating to trade. A wick-off pattern had never occurred before on this timescale, so most traders and investors were completely unprepared for it and simply didn't know how to trade it. As traders and investors, we always need to be prepared for the unexpected, and we need to view each market without bias, as preconceived notions that traders and investors can have can cause a trader to miss what's going on right before their very eyes. The two most important things to do during the bear market are 1. Be very patient. 2. Pick your altcoins very carefully. Bear markets can often last much longer than people think. They can last longer than people can tolerate. For most investors, they are long, boring, and depressing. But for patient investors who know what they are doing, bear markets can be a time of excitement and opportunity. The bear market is just like the January sale, which happens after the crazy December holiday season. During the January sale, things that were very expensive just a week before are now half price or less. A good example of this is the mince pie. This humble, tasty Christmas treat can cost up to £3 for a packet of 6. In the days leading up to Christmas, they are in high demand as people buy multiple boxes to make sure that they have enough for the whole family. Just 1 week later, once the holiday season is drawing to a close, demand for mince pies tumbles as most people have eaten way too many and would be happy not to see another until next December. It's at this time that you can find the very same mince pies for £1.50, £1 or even less, giving mince pie lovers the opportunity to buy 100 to 200% more mince pies than they would have been able to just 1 week ago. The crypto bear market is just like this. The only difference is that you have to wait longer than a week to get the best discounts. Even though the price drops at the start of the bear market may seem extreme, they continue to drop even further until the market finds an eventual bottom. Patience is key here. It will be extremely difficult to just sit on your hands doing nothing whilst crypto influencers tell you to go all in on crypto, but you really must ignore it and buy in slowly. Generally, during a bear market, Bitcoin fares better than most altcoins, as the Bitcoin dominance rises. What this chart shows is the value of Bitcoin as a percentage of the total crypto market. When Bitcoin is worth over 50% of the market, then Bitcoin is the place to be. When it is less than 50%, altcoins tend to outperform Bitcoin and often yield much larger gains. During the bear market, your focus should be on researching promising new altcoins that came out in mid to late 2021 and beyond, as these will have a much better chance of doing well than altcoins which were released pre-2021. We will go into great detail about the characteristics that the best performing altcoins tend to have later in the course. Everything worth doing in life takes time to learn and master. Unfortunately, many people who enter the crypto space think that they can become a trading genius after watching a few YouTube videos. They think that they'll just have a go at trading and that a rudimentary understanding of the market will be enough. This could not be further from the truth. Nobody thinks to themselves that they could become a pilot tomorrow after being a passenger on the flight to their favorite holiday destination. Yet many in the crypto space believe that they can instantly become a profitable trader and investor without the year's worth of education and experience that is required. It's almost impossible to learn anything useful during bull markets. Any money made during this time is down to circumstance and luck as opposed to skill. Most people who make money during the bull market will lose 80 to 95% of it during the first few months of the bear market. I'm not making fun of these people. I'm saying this because it happened to me when I first got into crypto in 2013. It happened to most of my friends when they first got into crypto, and it probably happened to you too. The only useful things that new crypto participants can learn from the bull market is that bull markets don't last, paper profits will vanish, you must take profit, and hodling is for fools. Unfortunately, these lessons are all learned too late. These realizations are made in the bear market. People only come to these realizations after having lost 90% of their portfolio. Realizing this after such heavy losses is a bitter pill to swallow, but if it's any consolation, it's what every new crypto trader and investor has to go through, so you're not alone. Bear markets are the absolute best time to learn and grow as a crypto trader and investor. During a bull market, there's far too much excitement. Everything moves up way too fast, and there simply isn't enough time to learn about crucial things like technical analysis, risk management, and fundamental analysis. This all changes during the bear market, when things slow down to a halt. Bear markets are boring. Weeks and months can go by when the market does nothing but go down. Then, even more months will elapse when the market barely moves by a few percentage points during that entire time. During a bear market, you should do these things to level up as a crypto trader and investor and prepare yourself for the next bull market. 1. Join crypto forums and learn about projects. After you've created a watch list of interesting crypto projects with strong fundamentals, you need to join the forums and Telegram groups of these cryptos. Read everything you can about the projects you're interested in and chat to people. Don't just chat to the users, chat with the developers too, as you'll find that crypto teams can be quite open and have much more time to chat to people who show great passion and interest in their project. This will give you the opportunity to ask questions and really learn about the crypto projects you're interested in, inside and out. 2. Go to crypto meetups. During bull markets, you can never find a place to sit at crypto meetups as they're full of eager investors. Unfortunately, the same can't be said during the bear market, when oftentimes only 2 or 3 of the most dedicated investors will bother to turn up. Make sure that you're one of those dedicated investors. In addition to being part of online crypto communities, you need to be part of offline communities. This serves 2 benefits. You will be able to interact with people in a way that is not possible online. You will be able to find out about crypto events in your local area. You will be able to exchange valuable pieces of investing knowledge with your friends, and you'll be able to find out about crypto job opportunities in your local area. Having real-world friends will help you cope with the depths of the bear market. Being able to talk with people whose portfolios have been just as decimated as yours will help you endure the cold, harsh crypto winter. Humor is really essential during the bear market, and it's good to have a group of people you can relate to so you can share jokes about the crazy world of crypto. 3. Learn all you can about trading and investing. You should learn about trading and investing from a wide variety of sources. Take courses, read books, watch videos. This needn't be expensive. In fact, you really shouldn't spend a lot of your money on your education. Beware of investing seminars or boot camps. I've tried a few of these early on in my crypto investing journey. Some of them cost 4 figures. Unfortunately, high prices are no guarantee of a good education, as most of these boot camps offered low quality information despite their insanely high entrance fees. I actually went to a crypto seminar once, and I asked the so-called trading guru why he doesn't use logarithmic charts when trading crypto. His reply was that he doesn't see the point, so prefers to stick to linear charts. This is a big mistake, as linear charts can make it harder to see the volatile price moves that are common in crypto. The scale on a linear price chart shows prices in equal increments. Because of this, large portions of an asset's price history become obscured once the price moves up a lot. Logarithmic charts, often referred to as log charts, show price movements in terms of percentage change. This can be very useful for crypto traders, as 4,000% moves in a year are absolutely not uncommon. To see just how different the 2 price scales look, let's look at 2 Bitcoin charts. These charts both display the price of Bitcoin traded on Bitstamp. They are both on the exact same time frame, and they both display the same period of time, yet they look completely different. The logarithmic chart clearly shows the trends of each phase of the market. Looking at the linear chart, one would think that nothing happened for most of this asset's history, as the price looks completely flat up until the point that it isn't. Going to seminars like this taught me the hard way that a high price does not equal a high level of education. 4. Practice your trading skills. The bear market is the perfect time to practice trading and to test out your trading strategies. This is when you'll get a good idea about their effectiveness, as bear market trading is in some ways more challenging than the bull market, as profits can be far harder to come by. Create trading strategies and backtest them thoroughly, then write down your findings. 5. Get a job in crypto. One of the best ways to learn about crypto is to get a job in the crypto space. That way, you will gain valuable knowledge and skills whilst getting paid to do it, so you won't have to fit all of your crypto education into the small amount of time that you'll have on your days off. By working in the crypto space, you will get first-hand information about new developments in crypto, which will give you an edge as an investor. Coding skills will give you a huge advantage, as well as access to the many opportunities that are available in this space. But don't think that crypto jobs are only open to coders. There are all kinds of positions open for passionate creative people, such as video editing, copywriting, and graphic design, as every crypto project needs good branding in order to attract investors. Most of these jobs are remote, so you can work from the comfort of your own home, and you won't need to relocate or deal with a lengthy commute every day. Doing these things will prepare you for the next bull market, as you will have amassed a huge amount of knowledge and experience that will be absolutely invaluable to you as a crypto investor. If you've just entered the market within the past year or two, then you're probably not a good trader yet. It doesn't matter if you've made a ton of money in the bull run. Anyone can make money in a bull market, so that's not indicative of skill as a trader or investor. To be a skilled participant in the crypto markets, you need to have been through at least one complete crypto market cycle. A crypto cycle equates to roughly 4 years, or one bear market and one bull market. Even then, there's no guarantee that you'll be a skilled investor, but at least you will have experienced those markets firsthand. You'll know what it felt like to make big gains, and you know what it felt like to make big losses. A good investor should have at least 50% of their bull market gains remaining during the bear market. That way, the funds can be used for reinvestments or for making changes in one's life. It's no good making huge virtual gains in your portfolio app during a bull market if you have absolutely nothing to show for it during the bear market, which always follows. It's a well-known fact that 90% of people who enter the markets lose money. The majority of those who make money are not retail traders and investors like you or I. Those who make money most consistently are institutions and hedge funds who have billions of dollars to play with. In order to be part of the small minority of traders and investors who do make money, it's essential that you gain a deep understanding of your own psychology when it comes to trading and investing. You need to understand what your hopes and fears are around crypto so that you can recognize how these can be exploited by market manipulators who get paid when you lose money. Think about how your current feelings towards the market may be manufactured by those who want you to take immediate actions that are not in your best interest. A common example of such situations are flash crashes and unexpected pumps. These events happen out of the blue and without warning, which can trigger a very potent fight or flight response in the minds of crypto traders and investors. When most investors experience a flash crash in a crypto that they're holding, their immediate response is to sell in order to prevent further losses. When most see a pump out of nowhere that seems to have been caused by some piece of news, many don't question the validity or timing of the pump, as they are already busy sending funds to the exchange so that they can quickly buy. What almost always happens in both of these situations is that the emotional and reactive trader is quickly punished as the price moves in the opposite direction of their orders. This is how the market manipulators, otherwise known as the whales, get paid. They enrich themselves by using their vast wealth to move the markets, which in turn causes reactive investors to react, which further enriches the whales, causing the cycle to repeat again and again. As the saying goes, money flows from the impatient to the patient. The whales aren't bad people, and you should not blame them for your losses. That would be a huge mistake, as that kind of thinking perpetuates a victim mentality that is very destructive to traders and investors. Whales are just like you in that they are simply acting out of self-interest. The only difference is that due to their experience and wealth, their actions can often be more effective than most. The size of their orders means that they can move the market around as they wish, but this can also be a big weakness for them, as these colossal sea mammals can't move without making a hugely visible splash. You can take advantage of this weakness by observing them and learning from their patterns of movement. In order to become wealthy like the whale, you have to think like the whale, which often means going against your instincts and instead doing the opposite thing. When the price rises suddenly on dubious news, instead of rushing to buy like the mindless masses, pause for a moment and think to yourself, is this the last opportunity I will get to buy at this price? Or is it possible that the price will soon be cheaper? When big pumps come out of nowhere, it's usually because a large holder wants to sell. What better way to sell than when everybody wants to buy? When a flash crash happens, instead of thinking, "Oh no, the market is dumping, I need to sell now," consider who benefits from those who are selling now, and also consider who's buying, because every trade needs two participants, a buyer and a seller. When a market drops suddenly, it often means that a big player wants to buy a lot of crypto. They don't just want to buy at its current price, which is too expensive for their tastes. Their solution is to engineer a crash. They place a large sell order or short position, which then triggers retail investors to follow suit. Then, once the market has dropped to the whale's desired level, they buy, and then the market rebounds. Next time, when a pump or dump comes out of nowhere, instead of being reactive like the masses, take a moment and think to yourself if you'd benefit by doing the opposite, delaying an action, or better still, doing nothing. As we saw in the flash crash of March 2020, the price almost always returns to where it was before the crash, so sometimes the best action can be inaction. After practicing this way of trading and investing for a while, you will find yourself in a position where you can take advantage of flash crashes, as you will have cash sitting on the side that will allow you to buy at low prices, just like the whales do. Even though cryptocurrencies like Bitcoin and Ethereum have only gone up massively over the long term, the vast majority of people have lost money. Here are the 5 main reasons why most people lose money in crypto. 1. They don't take profit. 2. They can't separate trading from investing. 3. They are too reactive to price moves. 4. They engage in high-risk activities such as leverage trading. And 5. They don't understand what they're buying. Failing to take profit. HODL culture is something that's very prevalent in crypto. HODL is a crypto acronym meaning hold on for dear life, and it is seen as a way of dealing with the extreme volatility of the crypto market. Everyone has heard stories about the person who bought thousands of Bitcoin in 2010 when it was super cheap, and then cashed out in 2011 thinking that they'd made a decent profit, only to realize years later that their impatience cost them hundreds of millions of dollars. Whilst hodling Bitcoin and Ethereum has been a good strategy so far, the same can't be said for most altcoins, which have tended not to make good long-term, multi-year investments. A good middle ground between trading and long-term investing is the practice of active investing, where investors buy and sell according to the 4-year cycle. Active investors in crypto buy during the bear market, hold for 2 years plus, and then sell during the bull market. Then they repeat the cycle, which allows them to grow their portfolio each time whilst protecting their capital during the bear market. Being able to separate and make a distinction between trading and investing is perhaps one of the most important things an investor needs to do. Trading and investing are completely different activities that require completely different mindsets. An investor should have a long-term mindset that spans months to years. Short-term price movements should not worry an investor. A trader should have a shorter-term mindset that spans hours to weeks. Due to this shorter-term outlook, a trader needs to constantly keep an eye on the price. What usually happens to new people in crypto is that they initially enter the market as investors with a view to keep hold of their assets for years. Then they're lured into day trading as a way to make a living from crypto, which causes some to view their entire portfolio as something that they should be trading on a daily basis. This is a big mistake, as trading is much riskier than investing. Unexperienced traders can easily lose their entire portfolio as they rarely practice good risk management. The right way to go about this for those who want to both trade and invest is to separate the portfolio into 2 pots. One pot is for investing, the other pot is for trading. The long-term investing portfolio should be the biggest. 90% should be the minimum size for new traders. The remaining 10% of the portfolio can be used for trading positions, as this is a much higher risk activity. Being too reactive. Those who are too reactive to price moves always find themselves on the wrong side of a trade. It's very important to take the time to think when big price moves happen, instead of reacting immediately. Immediate action is rarely the right course of action in crypto. This applies to both buying and selling. Oftentimes, the best course of action is inaction, as there is almost always a price bounce after every dump, and there is almost always a price correction after every pump. Engaging in high-risk activities. In crypto, the lure of quick gains can often be too tempting for many to resist. It seems like every other YouTube video has a sponsored segment for a leveraged trading platform that allows people with small amounts of capital to make huge gains. What they often forget to include in these sponsored segments is that leverage does not only amplify one's ability to make money, it also amplifies one's ability to lose money. The problem with most of these platforms is that the stop loss feature cannot be relied on, as they often fail to take you out of a trade during extreme price moves. Leverage trading crypto is highly risky, and it's something that I tell most traders to stay well away from. But if you really must leverage trade, be sure to use excellent risk management that goes well beyond stop losses. Assume that the stop loss will absolutely not work and size your positions accordingly. Basically, you should assume that any money you put into a leverage trading platform can vanish in an instant. If you're completely okay with this, then go ahead. Buying things you don't understand. Those who buy things that they don't understand soon learn the hard way that proper research is not optional. Before making any investments in crypto, it's important to have a thorough understanding of these key aspects. The first aspect is fundamental analysis. You need to know what problem the cryptocurrency aims to solve, how it intends to solve it, and who it's for. The second aspect is technical analysis. Is the current price cheap or is it expensive? Look at the chart and analyze the price history to get an idea about future price potential. A good understanding of technical analysis will help you buy low and sell high. The third aspect is tokenomics. It's very important to find out about the supply and demand dynamics of a cryptocurrency, as this can affect long-term price potential. If coins added to the circulating supply exceed demand, then it's unlikely that the price will rise. We will cover all of these aspects in much more detail later in the course. Over 90% of day traders lose money as their time frame is far too short. Long-term investors have made exceptional returns from Bitcoin. However, the returns one gets from holding Bitcoin long-term have diminished greatly, which leads many to seek altcoins as a good long-term investment. The problem with long-term altcoin investing is that investors have to be exceptionally lucky, as most altcoins are terrible long-term holds. If we look back at the top 20 altcoins from 2017, we can see that the vast majority would have been bad long-term investments. Of the top 20 altcoins, only 5 made a new all-time high. 75% failed to make a new all-time high. Investors who bought coins further down the list fared even worse, as many of these altcoins aren't even around anymore. Active investors tend to be the most successful in crypto, as they continuously monitor their investments and they buy and sell according to long-term bull and bear shifts. They differ from traders greatly, as active investors may only make a few trades a year and may not make any trades at all during some years. The best thing about active investing is that it gives you choices that long-term investors simply won't have. Active investors gradually sell their holdings during the bull market, which means that they're holding plenty of cash as the market declines. During the inevitable bear market, they then have something that most long-term investors could only dream about. They have choices. They can choose to spend their profits on absolutely anything they wish, or they can choose to reinvest in the same coins that made them huge gains during the subsequent bull market. If those coins are no longer around, or if there are more promising investments, then they can redeploy that cash elsewhere. Many long-term altcoin investors did not have the luxury of such choices during the last bear market. If their altcoins flopped or became completely irrelevant as new altcoins came on the scene, they were left holding a bag of worthless altcoins that in some cases were worth 99% less than they were selling for during the prior bull market. In crypto, it's very easy to get too attached to a crypto project, especially if it's been a profitable investment. When this happens, it's easy to become a victim of confirmation bias, the state of being where we only act on information that confirms our feelings. For example, if you're a big believer in the SafeMoon project and you love the coin as it made you huge profits in 2021, you may only seek and act upon positive information about SafeMoon. If an article or price prediction is positive, you may be inclined to buy more. If you see an article or price prediction that is negative, you may either flat out ignore it, dismissing it as FUD or fake news, or you may go a step further and buy as an act of defiance against the creator of that article and an affirmation of your loyalty and commitment to the project. It works in the other direction too. Let's look at the example of an Ethereum fan who is skeptical about Avalanche. Despite all the positive news, positive chart analysis, and great fundamentals, the Ethereum investor may ignore these facts as they conflict with his own biases. He thinks to himself, if Avalanche is so good, then that threatens my Ethereum investment. Therefore, Avalanche is a scam, its technology is inferior, and Ethereum is the better choice. He ignores everything good about Avalanche and only pays attention to the bad news. Even if the price of Avalanche soars, he assuages his feelings of FOMO by calling the investors stupid or uninformed. Be open to all pieces of information, both positive and negative. If you see negative information about one of your investments, pay attention to it. It may be nothing, but it could also be valid and it may save you a lot of money. I'm sure there are a lot of Luna investors who now wish that they paid attention to negative information about their investment back in April 2022. If they did, they would have saved themselves heavy losses. If you see positive information about a project you think is stupid, don't write it off. You may think that an altcoin is stupid, won't work, or is just a passing fad, but if the market thinks otherwise and the altcoin goes to the moon, you may have missed out on life-changing gains. When you first learned how to ride a bike or drive a car, you probably made quite a few mistakes before you got good at it. This is normal and is nothing to be angry or ashamed about. The same is true when it comes to trading and investing. It's irrational to think that you can enter the markets and become a pro after your first try. Losses are normal and are simply the cost of business when trading and investing. During the start of one's trading and investing journey, losses are basically the tuition fee that you must pay in order to gain the experience needed to become a great trader and investor. The absolute worst thing that you can do when you lose money is revenge trade. Revenge traders who make a small loss get angry at the market and seek to teach it a lesson as they aim to win back their losses plus a little bit more. This is a very dangerous game that should be avoided at all costs, because what almost always happens is that a small loss turns into a big loss, as a revenge trader gets pulled into a cycle of losing and then trying to reclaim past losses. The reason that this is such a terrible thing is that people who seek revenge act irrationally and foolishly. Instead of entering a trade or investment based on sound reasoning, they enter based on emotions and feelings of loss. Instead of revenge trading, there are some better ways of dealing with trading losses. Don't take the loss personally. Even the world's best traders and investors experience losses. Instead, you should reflect on the chain of events that led up to the loss. Write them down in your trading and investing journal so that it can be a record of your experience that you can refer to in the future. Losses are a great time to take a break from looking at the charts. Take some time out, go for a run, hit the gym, or go for a nice walk in the park. If your losses are the result of a swing trade or long-term investment, consider taking a longer break away from crypto. It sounds counterintuitive, but taking much-needed breaks away from crypto is essential when it comes to being a successful trader and investor. During a bull market, many are lured by the promise of quick gains. They may have read articles about newly minted teenage crypto millionaires, or maybe their friend made a quick buck and they think to themselves, well, if he can do it, then surely I can do it too. During the bull market, many will lose interest in anything that isn't crypto. Everything else seems dull and grey and slow in comparison. They often neglect their work as they think, what's the point of a boring 9 to 5 when I can make a year's salary in a week with meme coins? They neglect their friends who aren't into crypto because they are no-coiners who just don't get it. They neglect all their previous interests and hobbies because they can wait. Crypto is pumping now and they need to act fast. Many will even go to the extent of getting into debt to buy crypto. This is very, very dangerous. Unfortunately, many of these people turn out to be crypto tourists. Many fair-weather crypto investors who end up losing all of their gains at the start of the bear market will end up resenting crypto because to them it promised so much, yet delivered so little. The problem is that these people will rush into investing at the last minute. They'll make quick gains and they'll lose it all again because even though years have elapsed, they are still the same unsophisticated investors that they were years ago, because the one crucial thing that they didn't invest in was their own education. You should take a moment to congratulate yourself for sticking with crypto and taking your crypto education seriously. It's very easy to be a crypto tourist. It's very easy to be a fair-weather crypto investor. To remain during the bear market and to invest in your crypto education during this time puts you in the top 1% of crypto investors. Here are 6 key investing principles that every crypto investor should follow. 1. No one knows the future. Just because a market influencer has a big platform, it doesn't mean that they know everything. They often make big predictions, and when they're wrong, people forget. Don't take anyone's investment ideas on face value. It's always good to do research. Nobody is right 100% of the time. Nothing is certain. Think in terms of probabilities. There's always the chance that something out of the ordinary will happen. Don't bet on anomalies or things that are unlikely to happen, and never bet against the trend. 2. Diversify. Never put all of your eggs in one basket, even if it's just for a minute. Andrew Carnegie, the 19th century American industrialist, flipped that saying on its head by saying that the way to become rich is to put all of your eggs in one basket and then watch that basket. The problem is that this is a dangerous investing strategy for such a risky market as crypto, where projects fail all the time. The 2022 Luna collapse is a perfect example of this, where price fell over 99% in just a few weeks. By diversifying, you remove the risk of total ruin, which can put you out of the investing game permanently. Invest in competing blockchains. For example, if you're a big believer in Ethereum, maybe you should invest in Avalanche too. This will expose you to more upside in case one coin performs better than another. 3. Think in percentages and not dollars. Making $1 million when you already have 50 million is not the same as making 1 million from 10,000. Thinking about the dollar value will mess with your emotions, as you will start thinking about all the lovely things you can buy with it. Thinking in percentages will help you to become a better investor, as you'll be focused on the process as opposed to what you can spend your profits on. 4. FOMO is deadly. FOMO stands for fear of missing out, and it can be a very big problem in crypto. It usually happens when everyone is talking about a recent price rise. When this happens, many people fear that they will miss out on these gains, so they jump in. The problem is that if everybody is talking about a trade or investment, then you're already too late. By the time the average Joe knows about it, there are few people left to buy and the price will soon stall. If you make money from someone else's trade idea, you gain nothing other than money. There's no learning, and you don't improve as a trader if you can't critically analyze the market for yourself. 5. Don't buy things you don't understand. The first thing you should do before investing in a coin is to read its description on CoinMarketCap. This is where the research begins and ends for most people. If you can't understand what a coin does from its CoinMarketCap description, then the average Joe won't either. If they don't understand it, then they probably won't buy. If you can't explain what a coin does in very simple terms, then you shouldn't own the coin. You need to have an in-depth knowledge of your investments so that you're fully aware of the risks and benefits. Great fundamentals don't matter if the average Joe doesn't understand what a coin does or how it works. 6. Big money won't invest if they don't think retail will buy their bags. Whilst institutional investors may make up the largest percentage of investor volume, they won't enter a market unless they're confident that they'll be able to unload their bags to hungry retail investors. If retail are likely to be uninterested in a project due to the fact that it's too complicated or not cool enough, then investors won't come in. There are many cryptos with excellent fundamentals that require a PhD in computer science to understand. Retail don't buy these coins, and they remain low in terms of market cap. Retail investors like projects that are simple to understand. For example, a funny dog-themed meme coin, popular meme-based projects, coins with simple single use cases, and missions, such as the fastest layer 2 ever. When you're in the process of choosing your investments, it's important to think about how big the altcoins community is and how simple the project's aims are. Even if the project has complicated technology, it will do very well if it communicates its mission in an easy to understand way. Looking back to the previous bear markets, it's clear that around 12 to 18 months after the bear market started is a great time to start getting back into the markets and start building up long-term positions. The 2017 crypto bull market peaked in 2018, and the bear market started then as well. 2019 was when the market bottomed out and presented excellent long-term buy opportunities. If this pattern were to play out again, we can expect that 2023 will be a good time to start reinvesting. During the bear market of 2018 to 2019, a small handful of altcoins defied the bear market and began rising first. I like to call these altcoins the Phoenix alts. What is a Phoenix alt? A Phoenix alt is an altcoin that launched late in the prior bull market or during the subsequent bear market. In order for an altcoin to be a Phoenix alt, it must have been released midway through the parabolic phase of the bull market or later. Altcoins that existed at the beginning of the prior bull market or during a bear market do not qualify. To clarify using dates, any altcoin released after June 2017 would have been a 2018 to 2020 Phoenix altcoin. Some of the Phoenix alts of the 2018 to 2020 bear market are Aave, Link, Ren, BNB, Mana, and Matic. These altcoins were released in mid to late 2017 or later, and coins like Chainlink and Aave did exceptionally well and were some of the best performers during the 2018 to 2020 bear market. By 2021, these alts had made some of the most impressive gains. The one thing that connects the 2018 to 2020 Phoenix alts is that none of them were launched pre-2017. In fact, most of them launched between late 2017 to mid-2019. It's important to note that the coins just mentioned are no longer Phoenix alts, as they have already been in one or two complete bull markets. The Phoenix alts of this current bear market that began in 2022 are completely different. Aave fell 99% from its January 2018 peak. It then kept declining for over 616 days. It crossed the 200-day moving average in October 2019 and retested it in December 2019. It then continued to trend upwards until May 2021. It gained 150,000% from its September 2019 rounded bottom lows. Buyers had 3 months to buy at these prices. Chainlink was released in October 2017. It fell 90% from its January 2018 peak. It declined for 358 days before closing and remaining above the 200-day moving average in January 2019. It then continued to trend upwards until May 2021. It gained 26,000% from its December 2018 lows. BNB was released in July 2017, midway through the 2017 bull market. It pumped 37,000% to its peak of $26 in January 2018. It then fell 84% from its peak, trended down for 316 days, and reached a low of $4 in December 2018. It then began a new uptrend in February 2019, crossing the 200-day moving average. It then trended upwards until May 2021, gaining 14,000% from its December 2018 lows. During the bear market, you should create a list of no more than 20 altcoins that match the Phoenix Alts criteria. These are coins that were launched in mid to late 2021 and beyond. Ideally, these coins should be in the $100 million to $500 million market cap range. Coins that have a market cap below $500 million offer greater pump potential, though they're also much riskier. The coins you choose should have the best fundamentals, the best community engagement, great branding, high usage and user adoption, and great tokenomics. Start dollar cost averaging into these coins, buying the same amount each month, starting in early 2023. Here are some of the Phoenix alts that I'll be investing in starting in 2023. I like these coins as they match the Phoenix alt criteria, as they were all released after midway through the 2021 bull market, and they have good fundamentals. The coins are DYDX, Woo, Render, and Seedify S Fund. These coins are my own personal investments, and I'm not recommending that you invest in them. You need to do your own research and pick your own investments that suit your risk tolerance and investing time frame. These coins are just an example of what Phoenix altcoins look like. Crypto bull markets typically begin 9 to 6 months before the Bitcoin halving occurs, as investors start accumulating both Bitcoin and altcoins in anticipation of this event. The next Bitcoin halving should occur on or around May 4th, 2024. If we look back in time at Bitcoin's price movements, it typically moves above the 3-day, 50 and 200 period moving averages 9 to 6 months before the halving happens. A move above these moving averages has signaled the start of the bull run twice before. This happened just prior to the 2016 Bitcoin halving, and again prior to 2020's Bitcoin halving, although during 2020, Bitcoin's price movements were complicated by the pandemic. This Black Swan event, which caused a global market crash in March of the same year, pushed the price back down below both moving averages after the price moved above them just 2 months earlier. Black Swans notwithstanding, It's clear that the 9 to 6 month period before the next halving occurs is generally a good window of opportunity to start getting bullish on Bitcoin and Phoenix altcoins. When Bitcoin's 3-day 50-period moving average crosses over the 200-period moving average in an event called the Golden Cross, this should be seen as tentative confirmation that the bull run has begun. By combining the pre-halving 9 to 6 month window with the Golden Cross, you can get a good idea about when it's time to start preparing for the coming bull market. Fundamental analysis is a method of measuring the real or fair value of an asset in order to work out whether it's undervalued or overvalued when compared against other assets. Fundamental analysis is a very important tool that investors can use to help them decide which cryptos they should invest in. We can use fundamental analysis as part of a system for rating crypto investments by focusing on key aspects of each potential crypto and writing them down. Then, after doing this with all the cryptos you intend to invest in, you should have a better idea of which cryptos you want to invest in. Here are some of the most important aspects of fundamental analysis that you should consider when rating a cryptocurrency. What problem does the cryptocurrency aim to solve? This is one of the most important questions that we should ask ourselves when considering investing in a crypto. If this question is difficult to answer, then it may not be a good idea to invest in a coin with an ill-defined use case that is difficult to understand, as it will be less likely to attract buyers. Here are some examples of crypto projects that have simple, well-defined use cases that can be described in a few words. Bitcoin, a peer-to-peer digital money. Ethereum, peer-to-peer programmable money. Chainlink, an oracle that brings real-world data to crypto. Dogecoin, a dog-themed meme cryptocurrency. Uniswap, peer-to-peer decentralized crypto exchange. Notice how all of these examples are very easy to understand and can be described in a few simple words. If you can't explain to your grandma what a crypto does and why someone should own it, then it's unlikely to do as well as a crypto that can be easily explained. This is because most market participants don't have PhDs in computer science, so they buy things that are easy to understand. There are many technically sophisticated altcoins with amazing features that stayed relatively flat during the bull market of 2021 simply because nobody was interested in their complicated use cases. This partly explains why simple coins like Dogecoin or Shiba Inu that don't do anything revolutionary performed far better than technically superior coins like Algorand during the 2021 bull run. Whether we like it or not, technical superiority does not make a crypto pump if it's difficult for most people to understand. A simple use case, even if it's as silly as a fun dog-themed meme coin, can have a bigger positive impact than great technology. Some of the best performing altcoins are those that are both technically sophisticated whilst having an easy to use case that most people can understand. Ethereum is an example of a highly complex and sophisticated piece of technology that everyone can understand because everyone can see how valuable programmable money can be. How big is the market? It doesn't matter how amazing the tech is if nobody's using it. There needs to be a market for a cryptocurrency to succeed, and one of the best ways to gauge how big the market is to look at the users. DappRadar is a great site to see how many people are actually using these centralized apps. Simply click on rankings to see the most used apps. You should also click on volume to see which decentralized apps have the most value flowing across their networks. Networks with the highest amount of users who are spending a lot of money may be worth investigating as potential investments. How secure is the cryptocurrency? Blockchains and crypto ecosystems live and die by the security of their code. That's why it's essential that you research just how secure a crypto is, as cryptocurrencies are a big honeypot that hackers all around the world are trying to crack. Even if you do not have coding knowledge, you should always read the white papers of coins that you intend to invest in. Keep an eye on the project's social media channels, such as Discord and Telegram, as well as Twitter hashtags. If there's something you don't understand about the altcoin, ask members of the community to explain it to you. Check the cryptocurrency's GitHub page. This is where developers collaborate on the code. If an altcoin hasn't had any recent commits, these are updates, then it may be a sign that the developers aren't doing enough to maintain the coin. Technical analysis is the practice of using price data to find statistically significant trends and patterns that can help a trader identify potential opportunities and risks in a given market. Market technicians form their opinions on current price behavior by looking at the outcome of similar price behaviors in the past. Common chart patterns are the result of centuries of chart analysis that show statistically significant probable outcomes after the completion of certain chart patterns. When rating crypto investments, we can look at the chart patterns to help us decide whether the crypto asset is currently undervalued or overvalued when compared against other cryptos. In addition to looking at the charts of individual cryptos, it's important to look at metrics that show the state of the entire crypto market, such as the Bitcoin price chart, which sets the pace for the market, and the total cryptocurrency market cap chart. Looking at these charts will help to inform an investor of where they are in the market cycle and what actions they should be taking. Here are some of the main things to look for when ascertaining whether a cryptocurrency is undervalued or overvalued. Relative Strength Index. The Relative Strength Index is a momentum indicator that measures the speed and magnitude of price changes. The RSI indicator is displayed as an oscillator on a scale of 0 to 100. A value of 30 or lower indicates that the asset may be overvalued or oversold. This indicator works on any chart interval from 1 minute all the way up to 1 year. When using it for investments, the daily and weekly charts tend to give the best signals. When it's at 70 or higher, it indicates that the asset may be overvalued or overbought. The great thing about the Relative Strength Index is that it visually indicates when a coin may be overvalued or undervalued. In addition to showing overvalued and undervalued conditions, it can also indicate if a crypto is primed for a reversal in trend. This can be especially useful when it comes to timing entries and exits. When making medium to long-term investments, one should always consult the charts first to see if it's a good time to be buying. Long-term investors should focus on the higher time frames, so should base their analysis on daily and weekly chart patterns. Bullish reversal chart patterns. Everyone knows that the best investors buy low and sell high, but there's no point in buying something at a low price if it just stays at the low price. A good time to start buying crypto is when you see bullish reversal patterns emerging. These are chart patterns that show up towards the end of a bearish trend, when the trend reverses to become bullish. Here are some of the most common bullish reversal patterns in crypto. Double bottoms. Double bottom reversals happen when the price makes a sharp low. It then bounces and comes back down, making a new low that is usually slightly higher. Double bottoms can be a good sign that the trend may start reversing to the upside. Inverted head and shoulders. An inverted head and shoulders pattern has 3 swing lows, with the middle one, the head, being the lowest. Usually, the right shoulder should be slightly higher than the left shoulder. Triple bottom. A triple bottom is marked by 3 distinct swing lows, where each low is higher than the last. If the price starts quickly trending higher after the 3rd swing low, then that's a good sign that the support level will hold and that price may start trending higher. Here are some of the most common bearish reversal patterns in crypto. Knowing when not to buy is often more important than knowing when to buy, which is why it's also important to be aware of bearish reversal patterns that occur when the bullish trend comes to an end and turns into a bearish trend. Double top. This pattern is a double top. It's marked by two tops. Usually the second one is slightly lower than the first one, but that is not always the case. If price begins to fall sharply after testing this resistance level for the second time, then that's a good indication that it may not be the best time to buy. Head and shoulders. A head and shoulders pattern consists of three tops: a left shoulder, a head, and a right shoulder. The head is the highest top, and the right shoulder is often slightly lower than the left one. Investors who see this pattern forming should stay clear, as these patterns usually hint at continued downside moves. Triple top. A triple top is made up of three swing highs where each high is lower than the last. When this occurs, it's a clear sign that it's struggling to get past this price level and is likely to start falling soon. Moving averages. Moving averages are a great metric that can show whether a coin is bullish or bearish. Before buying any crypto, you should first check whether it's above or below its long-term moving average. Long-term moving averages are generally considered to be the 100 and 200 period moving averages on the 1 day to 1 week chart. The most common short-term moving average used in conjunction with the long-term moving average is the 50 period moving average, which should be used on a 1 day or 1 week chart. If the coin you're interested in has been above this moving average for a long time, and the moving average is starting to turn downwards, then it may not be a good time to invest. If the coin you're interested in is currently below the long-term moving average and is about to move above it, or if the short-term moving average has crossed above the long-term moving average, then this could be a good sign that the trend may be reversing to the upside. When making investing decisions, it's very important that you don't just rely on one single metric. As a market participant, your job is like that of a detective. You need to gather evidence from a wide variety of sources, including multiple technical analysis metrics as well as fundamental analysis factors. Once you have enough evidence, you will be in a good position to make good investing decisions. Tokenomics is a portmanteau of token and economics. In the crypto community, it's often jokingly referred to as pumpstrumentals, as it plays such a huge role when it comes to how much an altcoin will rise. Tokenomics includes market cap, token supply and demand, distribution, governance models, and other factors in crypto ecosystems in an attempt to predict the token's future price. A good grasp of a project's tokenomics is essential before making any new investment in crypto, as the supply and demand dynamics of the token can have a huge effect on its profitability. Token distribution is one of the most important things to consider when it comes to investing in altcoins, as a project that has an unfair distribution may create bad supply and demand dynamics which could ultimately hamper the altcoin's price potential. To find out how fair the token distribution was, you can look at the project's website or white paper. As well as checking these sources, you should also check the project's token contract by looking it up on one of the many scan websites such as Etherscan or BSCScan. To do this, go on a website such as coinmarketcap.com, then scroll down to Contract and click on the contract address. Once you're on the blockchain scanner site, click on the Holders tab and you'll see the percentage of coins that the wallets hold in relation to the total supply. Oftentimes, large wallets that hold over 30% of the supply may be exchange wallets. These are often marked with a label like Binance Hot Wallet. If this is the case, then this should not be a cause for concern. If the biggest wallets are unlabeled, some may be exchange cold wallets. Sometimes these are unlabeled for privacy and security reasons. However, large unlabeled wallets are always worth investigating further to find out who owns them. This is especially true with low and microcap altcoins that aren't on centralized exchanges yet, as large single wallets are one of the clearest signs that the coin is part of a rug pull. What are rug pull schemes? 2021 was not all sunshine and rainbows for crypto traders. An unfortunate side effect of the bull market was that it lured in scammers who were easily able to take advantage of eager and oftentimes naive investors. One of the most common scams were rug pull scams, which usually involve microcap, low liquidity altcoins that are traded on decentralized exchanges such as Uniswap or Pancakeswap. These altcoins are usually hyped up in Reddit forums such as Moonshots, the Reddit page dedicated to microcap altcoins. Oftentimes, the altcoin creators enlist the help of bots or paid shills who comment in forums and tweets to give the project positive exposure. This draws in tons of naive investors hoping to make a quick buck. Unfortunately, many of these investors don't stop to check the token contract address because if they did, they would see that there is a single large or multiple large wallets that holds the majority of the tokens in circulation. These wallets provide liquidity to the buyers. As more and more buyers come in, the price gets higher and higher. Once the price is at a desired level, the founders dump their coins on the market. The founders then make a quick buck, and the hapless investors are left holding a bag of worthless coins as the price craters in just a few hours. It's important to check how many tokens were bought during the token launch, as the price during token launches is significantly lower than it is after the launch. Token launches are often referred to as ICO or initial coin offering, or IDO, initial DEX offering. IDO refers to a token offering on a DEX, which is a decentralized exchange. During a token offering, the price will likely have been substantially lower than when the coin is later made available on centralized exchanges. So even though you may be looking at the charts thinking that the price may look really cheap now, you should be aware that the price was probably much cheaper before there were any charts for the token. In this case, the people who got in early are often venture capitalists, who may have bought huge amounts of a token at over 90% discount to the current price. If this is the case, these large holders may already be up 1000% plus on their investment, which could add tremendous selling pressure to the project. Vesting schedules. What often happens with new projects is that coins bought on launch are subject to vesting. What this means is that the tokens that were sold in the pre-sale stage of the initial coin offering may be locked up for a period of time. This prevents coins from being moved out of their wallets, which stops them from being sold. This is done in an effort to control the supply of coins on the market, which makes things fairer for new buyers. It's really important to check the details of this vesting schedule, which should be available on the project's website and white paper. Pay attention to the dates of the release and how it relates to the current stage of the market. If there are a series of big token releases coming up soon, then you may want to wait until after this happens, as the price will almost certainly be much cheaper once the new supply hits the market. A good way to assess the potential of an altcoin is to keep an eye on the altcoin company's job postings. A good site to use is cryptojobs.com. You can subscribe to their newsletter to get job postings sent to your inbox every week. If a company is hiring lots of people, that's a very good sign that the project is active, that they have enough money to spend on continued development, and that they have big plans for the altcoin project's future. This is especially true during bull markets, as many companies spend lavishly during the bull market and then run out of money for development during the bear market. Companies that continue to spend during the bull market are more serious about the success of their project than ones that only spend during the good times. When looking at job postings, look at the kind of vacancies that are available, as this may give you an idea of the altcoin project's future plans. If they have lots of design and media positions open, then they may be getting ready for a big marketing push. A company that's suddenly hiring lots of developers may be working on big changes to their altcoin. You should also look at the altcoin project's roadmap, which you'll find on their website. This will give you further information about their future plans. Don't just rely on one or two areas of investigation for your investing decision. In addition to job postings and project roadmaps, you should also look at project fundamentals, price analysis, social media posts and community engagement, tokenomics, and project branding. Looking at all of these areas will help you to form a balanced opinion about the altcoin, which will help you make better altcoin investments. A big mistake that many crypto investors make is that they fail to adequately prepare their exchange accounts so that everything is set up and ready for the bull market. People often put off things like KYC verification because it's a tedious thing that nobody wants to do. Nowadays, most big exchanges require you to verify your identity with them, or they will restrict how much you can trade or withdraw, and some exchanges may not allow you to use them at all until you have completed the KYC process. You may think that this does not apply to you, as the trading limits are so large that you don't have to worry about it, but you'd be surprised how much your portfolio can grow during a bull market. You don't want to find yourself in a position where your small $1,000 investment has blossomed into $100,000, yet you can't sell any of it as it exceeds your unverified account limits. This is something you want to sort out during the quiet calm of the bear market, when these kind of things can be completed very quickly and easily. Trust me, everything to do with exchanges takes much longer during the madness of a bull market. During this time, everyone is rushing to open an account on Binance and Coinbase. Everyone will be wanting to do their account verification at the same time. Because of this, exchanges will be under a lot of pressure. They may not have enough staff to process the torrent of new account signups, so you may find yourself at the back of the queue. This can be a very frustrating experience, which can put you at risk of being unable to sell at prices that are attractive, which can undo years of hard work and patience. Here's a list of the most important things you should do to make sure your exchange accounts are ready for the bull market. Make sure your accounts are KYC verified. Make sure your accounts are secured properly with two-factor authentication. Make sure you know how to use the exchange, such as how to set orders and how to deposit and withdraw funds. Make sure you know how liquid the exchange's trading pairs are, so you don't get any nasty surprises. You don't want to be in a position where you're trying to sell a large bag of an illiquid altcoin that doesn't have enough buyers for your order. In this tutorial, we're going to learn how we can quickly and easily turn our government money, so that's our pounds, our dollars, our euros, into crypto using Binance. Now, Binance is a pretty good place to get started with crypto because it's quick and easy to set an account up there, and they have a very, very extensive range of cryptocurrencies that you can buy. So first of all, what we need to do is click on this tab here that says buy crypto. And as you can see, there's a number of different buying options. You can buy via bank deposit, you can buy via credit or debit card, you can do peer-to-peer trading, you can do cash balance. There's all kinds of ways. But one of the quickest and easiest ways to buy is just using a credit or debit card. Now, you really wouldn't want to use a credit card. You should not be buying crypto on credit. So just use a debit card. Do not use a credit card. So we just click on this one here. And then I'm in the UK, so I pay with pounds. And I want to buy 1 Ethereum today. So I go down to Ethereum. I click on that. And then I just type in 1 for 1 Ethereum. I can see how much it's going to cost me. £880.25. And if you want to, you can do a recurring buy. So it's good for a dollar cost averaging strategy if you want to buy the same amount every month. But I just want to buy 1 today. So once that's done, I just click continue. And then basically after that, you just add your card, you put in your card details, you press continue and follow the prompts. And that's it. You have your Bitcoin or Ethereum or any crypto you want. And that's a good way to get started in the crypto ecosystem. And once you have some crypto, you can move it around to different exchanges, or you can trade it within Binance for other cryptos. So now we're going to learn about the different order types on exchanges, and we're going to be doing it on Binance. And the way we do it is we go to trade and we go to spot. Now most crypto exchanges are laid out like this in terms of their trading screen, and there's a few basic things going on here. So this is the crypto that's being traded, Bitcoin versus USDT. This thing here is called the order book. So this shows all the orders that are going on. And we can see the price, and we can see the amount of Bitcoin being traded and the total being traded at that price. So there's a lot of information going on here, and it can be quite useful because you can see where the buyers and sellers are and how they're interacting with one another. And this is the chart, and we have our volume bars here. And in the middle, underneath it, we have our controls for trading. Up here, this is where you choose what you want to trade. So it's laid out into different categories. We have BUSD. So everything here is traded against BUSD. And if you want to trade USDT pairs, you click USDT. There's BNB pairs. There's BTC pairs. So that's like Ethereum, Bitcoin, Avalanche, Bitcoin, stuff like that. And you just basically choose the pair that you want to trade. And you can search for whatever you want to trade. So for instance, if I type in Ethereum, it'll show Ethereum versus all the pairs that are available on Binance. And I want to trade Ethereum versus BUSD. So I just click on that here. Okay, and this brings up this window. So there's a number of different orders we can do. So I have some Ethereum in here. And what if I think it's going to go up higher to a certain price and I want to sell it? So right now it's just over $1,050. What if I think it's going to go to, let's say $1,200? Well, what I'd do is I would put that price in here. So I type it in, 1,200, and then simply drag this along. So you select the amount of Ethereum you want to sell at that price. So you can select as much of it or as little of it as you want. You can either type it in or you can just drag this. But let's say I want to sell all of it at 1,200. So that's done. And I simply press sell Ethereum. Okay, and that order is basically put through now. So it's not sold it yet because we haven't reached 1,200 yet. But if we look down here and open orders, we can see that the order is waiting. So it's just waiting until the price gets reached and then it would trigger. So that's one order type. That's a limit order. The other type of orders we can do are stop limit orders. So they are slightly different to limit orders. And the way they work is kind of like a protective order. So I have some Ethereum here now and I intend to hold it. But what if it went down to like $900? I wouldn't be very happy about that. I might not want to hold it if it's going down. So in order to protect myself, what I would do is I would click on here on stop limit. And what you do then is you select the stop price. So the stop price is the price where, say there's a support level at $900 and you think if it goes below $900, it could crash all the way down to 800. Okay. So obviously you'd want to get out as quickly as possible. So what you would do is you would put the stop price here of 900. Okay. And the limit price is the price that it will trigger once it hits the stop price. So basically it's like a trading robot essentially. So if the price was to go down to 900, what Binance would then do is it would create a limit sell order for you at a set price. And what I like to do is I like to have the limit sell order quite close to the stop order. So in this case, I'll put 895. Okay. So in this scenario, if the price of Ethereum went down to $900, Binance will immediately set a sell order for 895. Now you may be thinking, why not just set it at 900? Well, that can work sometimes, but if the price fell very, very quickly, it may not it may not trigger in time. Okay, so the price could go right through 900, right? And then because the limit sell order is all the way up at 900, when the price is say at $890, that limit order won't get triggered. So it's always good to put it a little bit lower. I could even put it a little bit more low just to be on the safe side. So we'll put it at 890. Okay, so that should give it enough time to trigger and to take me out of the trade. And then you basically say how much you want to sell. Okay, so you don't have to do all of it. You can do as little or as much as you like, but I'm going to sell all of it. So once that's done, I simply press sell ETH and I press confirm. And this order is waiting. So I haven't actually sold it yet, but it's a protective order just in case the price was to fall. So now we're going to look at one of my favorite order types, and this order type is the one cancel the other order. So let's picture the scenario. So you've just bought some Ethereum and you think it's going to go to a certain price. Okay, let's imagine the price now is, what's the price now? $1,053. Let's imagine that based on our trading, based on our technical analysis, we think it's going to go to 1,500. Okay, so in that scenario, what you would want to do is you would want to do a number of things. You'd want to put 1,500 here, and that is your limit price. So that's where you hope it's going to go. But what if it doesn't do that? Well, if it doesn't, then what you'd want to do is you'd want to have a stop. So if it goes down to 900, okay, I'd want to get out. So I'd put 900 here, and then you want to put a limit price that it will sell at if it goes to 900. You don't want to put 900 because when the price is falling quickly, there may not be enough time for that order to trigger. So it's always good to put the limit sell order and in a one cancel the other order situation a little bit lower. So I'm going to put it at 890. Okay, and then I want all of the Ethereum to be affected by this order. So I'll drag the slider all the way up to the top. So this is how the order looks. If this is the positive scenario, if Ethereum goes up to $1,500, it will sell the Ethereum and I'll make a nice profit. I'll make $444 profit. If it goes down to 900, I'll incur a loss. Okay, but even though it will be a loss, it will be a much less bad loss than if the price went down much, much further. Okay, so that's why we do these kind of orders. These kind of orders are orders that you make when you are expecting something good to happen, but you put stuff in place just in case something bad happens. And then you simply click sell ETH. And it says here that the OCO order is created. So this order is waiting for us. And we have two orders. Here we can see that we have a limit maker order at 1,500. So that's if the positive scenario happens. And we have a stop loss limit order for 890. That's if the negative scenario happens. So we are covered both ways. And that's why these OCO orders are so powerful. They are really, really useful when it comes to trading. In this tutorial, we are going to learn about how we can buy Ethereum tokens using Uniswap, the decentralized exchange. So this is the website you need to go on. It's app.uniswap.org. And then the first thing we need to do is unlock MetaMask. So I'm going to type the password in. Okay. MetaMask is unlocked. And now the next thing we need to do is click Connect Wallet to connect MetaMask to Uniswap. So that's done. I already did this before, so it's very quick. But if you're new to this, there's an extra confirmation that you need to do in MetaMask. So now that it's connected, there's two balances here. So there's an Ethereum balance and there's a USDC balance. Now I want to buy using USDC because I want to save the Ethereum for fees. So I click on USDC and I want to use the maximum amount. So I click max. If you don't want to use the maximum, you just type in whatever amount you want to use. Okay. And now I want to select the token that I want to buy. So the most common tokens, the most popular ones will all be here. You can just quickly find them. But if there is a token that is not so common, so something like a small cap or a micro cap, then you will need to turn on one of these token lists. So the coin market cap token list, we can see here that it's got over 6,700 tokens. And the CoinGecko one has almost 4,900 tokens there. So you can click on these lists and they will expand the amount of tokens that you can buy, basically. But the token we want is quite a common, popular one, so we don't need to do that. So I'll just click on this and I'll type in the token I want, which is Mana Decentraland. So I click on that and it's now going to show how many I can buy. So with my 200 USDC, I can buy 243 Mana. And now I need to click on this, which will allow Uniswap to use my USDC. So I click on that. And this is the message. So I have to click on this to sign it. Then this basically grants Uniswap permission to use my USDC for this transaction. So I click sign. And I'm using my Ledger wallet. So I'm actually signing it on my Ledger wallet. This is the safest way to use MetaMask. But, you know, if you're just using it on the app, then you just sign it on the app. So I have signed the message and you can now see the swap button is highlighted. So all I need to do is click swap. And this will show all of the details that I need to check just to confirm that everything's all good. So this is what I'm expecting to get, 243 Mana. Although sometimes there's slippage. So this could be the minimum. This is the minimum that I will receive. And then we can see the network fee. So it's going to cost $4.85 worth of Ethereum, which is pretty cheap compared to last year. You know, I remember last year I was paying sometimes like $50 to do a Uniswap transaction. So it's pretty good at the moment. So basically we just click confirm. And then we need to confirm it again in here. This is going to show us the gas fee. So there is a gas fee in addition to the Uniswap fee. And this gas fee is not too bad. And then click confirm. And I'll need to confirm it in my ledger as well. Okay, transaction submitted. And that's basically it. So I'll just close this. And we can see it's pending and it's already done. Okay, so now I have 243 Mana and we can see the balance is reflected there. So if we go up to here in assets, it doesn't show. Now that's not something that we should be worried about. The Mana is there, but what you'll need to do is sometimes refreshing the list works. Okay, so refreshing the list has shown it there for us. If that doesn't work, if you're buying a token that's more of an obscure token, so something like a small cap or a micro cap, then you'll need to click on import tokens, and you can either search for this directly by just typing the name in, or you can enter in the token contract. And the way you enter the token contract is you'll go to a website like Etherscan. So we'll do that right now. So we'll see how we can do that. So we'll just type Etherscan into Google. And let's search for Mana. Okay. So this is the token contract. So basically we want to copy these details here into MetaMask. So we'll open MetaMask, we'll expand it so it's always there for us. And we don't actually need to do this, but this is the process you need to do if your token doesn't show up. So we'll paste the contract address in. It says it's already been added. Okay, let's just add a different one so we can see how to do it. We're going to add synthetics. So what you need to do is copy this address, paste it there, and it just comes up with the rest. It says SNX and 18. If it doesn't do that, because synthetics is quite a popular one, so it's just populated it by itself. If it doesn't, you'll just need to type in those details there, and you're basically just copying this, the decimal, and you just type in SNX. So if we add custom token, it will show up, and we don't have a balance of SNX. So yeah, that's basically it. We now have 0 USDC and 243 mana. And that's how you buy tokens on Uniswap. In this tutorial, we're going to learn about how you can add alternative networks to MetaMask. So when I say alternative networks, I mean stuff like Binance Smart Chain, like Phantom, like Avalanche. You can add these networks to MetaMask so that you can have it there in addition to Ethereum, which is the default network on MetaMask. So first of all, you want to go to the MetaMask website, metamask.io, and you scroll all the way down to support, and then you click on support. And this is the support site, and then you scroll all the way down again, and you click on network profiles. Now, you don't have to do this. You can go to the individual chain websites. You can go to Binance chain website or Polygon or Avalanche, and there will be details there that will tell you how you can add these networks to MetaMask. But I find this quite handy because it's all in one place. So let's say we want to add Binance Smart Chain. We click on Binance Smart Chain, and these are the details for Binance Smart Chain. So how do we get these details? How do we get these network details into MetaMask? Well, we click on MetaMask here, and then we click these three dots and expand view. And what that will do is it will just keep it open in a separate tab for us. So it's always open and nice and easy to use. Then we click on this circle and we click on settings, and then we click on networks. Now these are the Ethereum network details. You want to leave those alone. We don't need to touch those, and we don't need to touch these either. These are test networks for developers. So we're not worried about that. We just want to click on add network, add a network. And then it's basically just copy and paste. So we copy and paste the network name into here, and a new RPC URL. We just simply copy and paste this RPC URL, paste it in there, get rid of some of the spaces. The chain ID is 56. You can either copy and paste or type 56. And the currency symbol is BNB. Let's type that in. It will highlight orange because it can't verify it, but it's really nothing to worry about. It basically, any network that's not Ethereum, it won't be able to verify. But it's perfectly fine. It's just a ticker symbol. And then you want to add the block explorer. So for this, you right click on here and you click copy link, and then you paste the block explorer link into here. So what the block explorer is basically is if you want to, when you have a transaction that's progressing, if you want to check its progress, you can click on it and it will go to the block explorer and it will show you how it's progressing on the blockchain. So you click save, and now we have Binance Smart Chain, and you can see a little BNB logo on there. And if you want to select it, you just click this drop down menu and you click Binance Smart Chain, and you can do stuff on Binance Smart Chain, like you can go on Pancakeswap and all the other stuff on BSC. And if you want to go back to Ethereum, you simply click on Ethereum and you're back in Ethereum. And that's how you do it. And you can add all of these different networks, Binance Smart Chain, Polygon, Avalanche, Phantom, Harmony, anything you want. You can add it all into MetaMask and access all of these networks through the same wallet. In this tutorial, we're going to buy Binance Smart Chain tokens on Pancakeswap, the decentralized exchange that runs on Binance Smart Chain. Now, the first thing we're going to do is we're going to make sure that our network is on Binance Smart Chain. And if you don't know how to add additional custom networks to MetaMask, check out the tutorial on that. So what we do is we click down this and then we click Smart Chain. So we're now on Binance Smart Chain and we can see that we have some BNB on there. So what we need to do now is we need to connect our wallet. So we click connect, we click MetaMask, and then we select the address we want. So I want this address here, which has some BNB in it. And then I click next and I click connect. Okay, so that's all connected now. So now what we want to do is we want to click on trade and we want to click swap. And what I want to do is I have some BUSD on here. So I want to click on this and we can see the BUSD I have on here. I've got 200 BUSD. So I want to click on this. And the token I will buy is, let's buy some cake, pancake, we might as well. And I'm going to spend 200 BUSD on Pancake, and that will get me 67.7 Pancake. So yeah, I'll click enable, and I just have to give Pancakeswap permission to access my BUSD. So I click confirm. And I'll need to confirm that in my ledger because I'm securing my MetaMask account with my ledger, which is the correct and it should be the only way to do it really. Okay, that's done. So I just got to wait for this to be enabled. Shouldn't take too long. Okay, it's done. And now I can press swap. I confirm it here. And then I need to confirm it in MetaMask. And we can see that there's this fee, which is like next to nothing basically. That's the really good thing about Binance Smart Chain. Very, very low fees. And then I need to confirm it in my ledger again. So I'm just doing that now. Okay. And the transaction's been submitted. And now we have this menu here. So this is really useful, especially for small caps and micro caps on Binance Smart Chain. You want to click this so it's added to your balances. So you click on this and then it will add cake to my list of tokens. And we press close. And now if I look in my assets, I can see the cake there. Okay. If I didn't do that, if I didn't add it, I would have to manually import it. And the way you do that is you go on here and then you go into a website like BSC Scan. So we'll do that now. And then you just search for it. So we'd search for like cake, pancake. And we basically enter these details here. So the contract, the decimal, and we would enter all of that in here. I'll just bring it up here. Import tokens. So you'd enter all of that information in here. But we don't need to do that because it's already there. So yeah, that's how you buy tokens on Pancakeswap. In this tutorial, I'm going to show you how to correctly secure your crypto exchange accounts using two-factor authentication. Now, we'll be doing this on KuCoin today, but this works on absolutely any crypto exchange. Pretty much any crypto exchange that is not a scam has the ability to secure your exchange using two-factor authentication. Now, this is an absolutely essential step that you must do before you put any crypto or any funds into a crypto exchange. And it's not only useful for crypto exchanges, you should also do this for the email addresses associated with those exchanges. So I'm just going to log in here now. And I'm going to enter the password using my password manager. Okay, so now we are in. And then you want to find settings on your exchange. Now, they are often in different places, but it's usually under account security. And then we want to go on to this thing here that says Google verification. Now, different exchanges call it different things. This verification is not really a Google thing. It's an open standard, but the most commonly used verification app is called Google Authenticator. But there are many ones. There's Authy, there are open source ones. There's all kinds of different authenticators, and they all have their pros and cons. But they all use this open standard. So once you've logged in, you click on configure, and then you need to send yourself a verification code first. So I'll just do that. Okay, so I have my verification code and I've put it in, and now I am presented with this. So this is called the 2FA, which stands for two-factor authentication verification. So what you need to do here is you need to basically get out your phone and you need to download an app called Authenticator, one of the Authenticator apps. Today we're going to use Google Authenticator just because it's the most commonly used one, but you can use any that you like the most. And then you want to get your phone out and you want to scan this code here. Okay, and once that's done, you are ready to go ahead. But before we do that, what we want to do first is we want to make a screenshot of all of this information here. So you want to screenshot the QR code and you want to screenshot this number. And you shouldn't save it on your computer. You should screenshot it, put it in a Word document or something and print it off, and then just delete that file. And the reason you want to do that is in case your phone breaks, say your phone breaks or you lose your phone, unless you're using 2FA apps that back up your keys, then you will lose your two-factor authentication key and you won't be able to get in. So it's really important to back up this information. So once you've successfully backed it up, you need to open up your phone app, and then you need to enter in the one-time password that it gives. It will give you a new password every 30 seconds. So here's the one it has now. So I'll just put this in. Okay, and I click activate. Okay, and that's done, and it's basically set up now. So next time I want to log in, what I need to do, I'll log out and log back in again so you can see how this will work. Okay, so I'm now logging back in. I want to put in the password using my password manager. Okay. To do the annoying capture again. Super annoying. Okay, so this is the extra step. So you just saw we put in the username and password, but we now also have to put in the one-time password. So I'm putting in the one-time password now. Okay, and submit. And now we are logged in. So now every time you want to log in again, you'll need to put in not just your username and password, but your one-time password as well. And that's how you set up two-factor authentication. And you really need to do this on everything. So you need to do this on your email address associated with your crypto account. And to be honest, I like to add two-factor to everything that's important to me, because it's just an extra step. It's an extra layer of security that you can use to help to protect your privacy. When preparing for bull markets, one of the most important things you need to do is consider how you're going to securely store your long-term crypto holdings. Whilst exchanges, mobile wallet apps, and browser extensions are very convenient, they are not secure enough for storage of long-term crypto holdings, so it's absolutely essential that you store large amounts of crypto in a hardware wallet, which is by far the most secure way to store your crypto. Exchanges are not banks. They get hacked all the time. If we look back over the past decade, an exchange hack happens almost every year. During my time in crypto, I have personally lost crypto that was kept on exchanges, and I can tell you that it's not a pleasant experience. The first incident happened in 2016 during the Bitfinex hack, and the second happened in 2017 when the now defunct exchange BTCE went offline. Fortunately, I only kept small balances on exchanges for trading, but those who had their entire portfolio on these exchanges were not as lucky as I was, as they incurred losses that are almost impossible to recover from. App wallets and browser extensions aren't much better either, as the recovery phrase is shown on screen during the setup process of these wallets. This makes these wallets vulnerable to viruses that may be on your device during setup. As hardware wallets are self-contained devices, they don't have this problem, which is why they are the safest place to store your crypto. When preparing wallets for the bull market, you should research the kind of wallet apps available to see if they are supported by your hardware wallet. It's also useful to send test transactions from your wallet so that you can familiarize yourself with each altcoin's wallet app, as they all work slightly differently. Doing these things will help to protect your precious crypto and will give you much needed peace of mind. So you've just gotten yourself a brand new hardware wallet, and you need to write down your backup phrase. This small piece of paper with 24 words on is probably the most valuable piece of paper you will ever own in your life. The question is, where will you keep this piece of paper to ensure that it and your crypto remain safe? You could just keep it in your house, in a safe perhaps, or maybe in a biscuit tin under the stairs. But what would you do if you came back to your house in flames? Can you be sure that your hardware wallet and that little piece of paper with your recovery phrase on won't be turned to ash? But of course, you've got a backup copy at your grandma's house, so your crypto is safe from fire risks. If the house burns down, it's no big deal. You can just go to grandma's and recover your crypto with the recovery sheet you kept there. But what would happen if a thief decided to enter your house? Could you be sure that he wouldn't find your recovery phrase? Did you really hide it that well? When it comes to crypto, critical tasks shouldn't have a single point of failure. In this picture, we can see two missileers. They are responsible for firing missiles, some of which are nuclear. If there was just one missileer and that missileer had a bad day and decided to launch the missile, then the consequences could be catastrophic. That is why missile silos always have two who both need to turn their switches simultaneously in order to launch a missile. This philosophy of redundancy should also apply to the critical task of keeping your crypto recovery phrase safe and secure. Crypto philosophy says that you can be your own bank. It sounds great, it sounds liberating, and it is, but being your own bank is hard. Banks have IT departments and admin departments, and most importantly, security departments. All that responsibility falls on your shoulders. If your bank card gets lost or stolen, it's no problem. There's a number to call with friendly people on the other end of the line who will make all those problems go away. If your crypto wallet and recovery phrase gets stolen, who will you call? There's a solution to this problem. It's called Shamir secret sharing. It's a novel secret sharing technique that offers redundancy and concurrency, which can protect your crypto from life's most tragic events. Instead of writing your complete phrase on one sheet of paper and storing it in one place, the phrase is written partially in a special sequence on 3 pieces of paper. These 3 pieces of paper are then kept in 3 different locations. In order to recover the full 24-word password, you just need 2 out of the 3 pieces of paper. Any 2 will work just fine. For example, you could keep 1 sheet in your house, 1 at a relative's house, and 1 in a safe deposit box. If any out of those 3 sheets were destroyed or stolen, your crypto would remain safe. This backup solution is infinitely more secure than the default backup method that crypto wallet providers suggest. In this video tutorial, we will show you how to back up your wallet using this method with the recovery template sheets included in this course. In this tutorial, we're going to look at one of the most secure ways that you can back up a brand new crypto wallet. This is far more secure than the default method, where you simply write 24 words on 1 sheet of paper. When done properly, this wallet backup method will help to protect your funds from theft, loss, and fire risks. This tutorial is for those who want to set up a new crypto wallet. If you already have a crypto wallet backed up using the default method and you'd like to move to this more secure method, then you can simply copy the 24 words written down on your existing backup sheet onto the free recovery template sheets included in this course. Please take your time when backing up your wallet and create a practice wallet first to make sure that you can recover your funds if you need to. Before starting, you'll need to download and print the wallet recovery template sheets included in this course. You can also pause, screenshot, and print these 2 pages if you choose. Firstly, you'll want to write down your wallet type, as well as any names or labels you've given to your wallet. Repeat this for the 2 remaining sheets, so that all sheets have the same wallet details and date. Plug in your hardware wallet and set it up as a new device. Be sure to follow the on-screen instructions. The wallet we're using is a Ledger Nano S. Most hardware wallets work in a similar way. If you have a different wallet, make sure you carefully read and follow its instructions. Once you've set up your PIN, the wallet will prompt you to back up your recovery phrase. This step is very important. Your recovery phrase is the key to your crypto, so it should be treated with great care and respect. The wallet will show words in numerical order. When you see a word, write it down on all sheets that have a corresponding number. Here, we can see that word 1 is candy. Word 1 should be written on sheets 1 and 2, but not 3. This is just a tutorial. You should not be writing down the words in this tutorial. Write down the words that your wallet tells you to write. Word 2 is never. Word 2 should be written on sheets 1 and 3, but not on sheet 2. As you can see, you only write the words in the white numbered boxes. Do not write any words in the grey boxes that have no numbers beside them. When you have finished, your sheet should look like this. Each of the 3 sheets should have 16 out of the 24 words on. If one of the sheets gets lost or stolen, you won't have to worry, as the thief would need all 24 words in order to steal your funds. If the worst happens and your wallet along with one of the recovery sheets gets destroyed in a fire, you will still be able to recover your funds so long as you have access to the 2 remaining sheets. In order to get the redundancy and security benefits of Shamir secret sharing, you should keep each sheet in a separate location. Do not keep all these sheets in the same house. This is the power of Shamir secret sharing. It offers greater redundancy and security than simply writing down all 24 words of your recovery phrase on 1 sheet of paper. A take-profit plan revolves around a number of price zones where an investor intends to sell specific percentages of his or her portfolio. The price zones and percentages of crypto sold at those zones all need to be decided and written down in a detailed plan in advance, so that when the coin you're holding does eventually go up, you can simply refer to your plan instead of having to decide on the day whether you should be selling. Investors who don't make a plan and come back to the markets a year later, once the coin they're holding has risen a lot, often find that they are reluctant to sell. These investors may be influenced by positive market sentiment, which causes them to think that the market will just go up forever. They hodl onto their coins for far too long, and before they know it, the market crashes, wiping out their paper gains in the process. This happens to almost everyone during their first crypto bull market, especially if they are new to investing. It happened to me, it happened to all of my crypto friends, and it will probably happen to you too if you don't make a detailed take-profit plan. You should have a good idea about where you intend to sell a crypto asset that you intend to buy before you even buy it, as you need to consider the risk and reward potential of that investment. Everything you buy has a cost, not just a financial cost, but an opportunity cost, as you can't spend the same money twice. By buying coin A, you no longer have the opportunity to buy coin B, so you need to buy carefully and work out whether coin A or coin B has the most potential. Technical analysis, fundamental analysis, tokenomics, and market sentiment are all factors that should be considered when crafting a take-profit plan. It's important to note that although this plan should be well structured, it also needs to be flexible, especially in regards to price and time. Regardless of how much technical analysis you do, it's impossible to predict the future. Markets are ultimately driven by people. People change, and so does the world, which can in turn affect the markets. Your take-profit plan is not something that will tell you exactly where to sell. It's something that should be used to give you an estimate of how much profit you could make if you're able to sell at certain prices. That's why I was very careful to say price zone and not price target, as many traders hold out for a specific price to be reached, only to find that the price they're waiting for doesn't get hit. Even though you'll need to write down specific sell prices in your plan, you need to be flexible enough to change if the market changes, and you should have contingency prices that you can sell at if you need to. Don't plan to sell crypto at big round numbers, such as $1, $100, or $1,000. Round numbers are very emotional for investors, so many will set their sell orders at those prices. When many people set sell orders at a certain price, what often happens is that the price never gets hit, so it's best not to set sell orders at round numbers. For example, instead of planning to sell some Ethereum at $10,000, consider a less emotional price, such as $9,872, as most traders are unlikely to set sell orders there. In addition to round numbers, popular Fibonacci extension levels should also be avoided, as there will be a lot of sell orders there too. Instead of planning to sell exactly on the 61.8% Fibonacci extension level, consider selling a bit before to increase the chances of your order being filled. Your plan needs to be written down somewhere where you can easily access it when you need to. That way, when the moonshot prices you dreamed about finally become a reality, you will know exactly what you need to do. In this tutorial, we'll be looking at how we can create take-profit plans in order to ensure that paper gains are turned into real gains. Creating a take-profit plan is absolutely essential for two reasons. The first is that it helps you come up with reasonable price targets using technical and fundamental analysis. The second reason is that a written down plan will help to inoculate you against FOMO during the peaks of the bull market. This is really important on a psychological level because it will be much easier for you to sell when you know that you have a plan that you need to stick to. When you're creating a take-profit plan, there are two main factors that you need to consider. The first one is all about technical analysis. So you're looking for technical evidence that the coin that you intend to buy or that you already hold can reach the potential price targets that you have in mind. The second factor is you're looking at the niche that the coin is in, okay? So you're looking at where other coins are in that niche, where they lie. And you should be paying particular attention to the ones that are at the top of the niche. So looking at this crypto gaming category, we can see that Mana is at the top of the niche. It was a very, very popular game in 2021, and there's still lots of people playing it. It's a working product, so it has a very high market cap. So we're going to copy this market cap, and we're going to put it in our Mooncalc, and we're going to use that later. So what we want to do is we want to go down this list, and we're looking for coins that could potentially be at a similar market cap, coins that have potentially high growth potential. So VRA is an interesting coin. It's all about game streaming, a market that's growing very, very rapidly. And we can see that it has a very, very small market cap. So it's only 51 million at the moment. And there's 10.34 billion in circulation. So we're going to put this information into our Mooncalc. So first of all, we're going to write the ticker here. And we're going to use this as a potential buy price. And in here, we're going to put the market cap. Okay, so we have 10.34 billion there. So we can see immediately that if VRA was to reach Mana's market cap, remember Mana's market cap was 1.55 billion, VRA would be worth 15 cents. So that's quite interesting to know. That's quite a increase. So let's look at the charts and see if we can find evidence to corroborate our theory that VRA could reach that level. So we just want to search for VRA. On this one here, there's lots of price history. So we can see that in 2021, it reached 9 cents. And 9 cents isn't too far off from 15 cents when you look at the move in its entirety, okay? It started the year way under a cent, okay? And then it ended the year up at 9 cents. So it's possible. And the market cap wouldn't be ridiculous, okay? We're not talking about, hundreds of billions of dollars. We're just talking about $1.5 billion. Very small in crypto terms. And if we were to draw some Fibonacci levels, we can see that this swing high to this swing low came up with this 1.618 level, which it hit perfectly, okay? So when people say that Fibonacci doesn't matter and it doesn't work, I mean, this is clear evidence that it worked because, people back here drawing this from this swing high to this swing low, they wouldn't see the future. And this perfectly predicted that it was hit. So there is potential that it could get up to here. I mean, the 2.618 level is 13.6 cents, okay? The 3.618 level is 18 cents. So we're going to use this information here. And what we're going to do to make life easier is we're going to add price levels to the Fibonacci. So we're going to put these prices into here. And the first one we're going to do is 13 cents. The second one is 18 cents. Actually, we'll do this for the second one because that was our original target. And then we'll do 18.6. And then we'll do the 4.618 level, which is 23 cents. Okay. So now we want to come up with a budget. I mean, we want to work out if it's worth our while buying VRA. So let's put in $1,000. That seems like a decent amount. So if we budgeted $1,000 into VRA at the current price, we'd be able to buy just over 200,000 VRA. Okay. So we're going to copy this and we're going to put it into holdings, paste special, and then you paste values only. Okay, so now we have some holdings here. So now we have holdings and we have, we know how big the circulating supply is and we have potential price targets. Okay, so now we want to work out how much we should sell at each price target. So we'll just play around with it. So we'll start off small. We'll sell 10% at 13 cents. So if we did that, that would yield £2,290. Okay. And there'd be £20,000 worth left at that price. And then if we say we want to do 20% at 15 cents, okay, that would bring a cumulative return of £7,313. What if we wanted to get bigger? Because we're looking at 18 cents here right now. And 18 cents is very, very close to the top of this extension. So it would be wise to maybe have a much bigger take profit percentage here. So let's do 50%. We can see that the TP3 cumulative returns is almost 23K. So we still have 20% left in terms of our total holdings. So we're going to put that 20% in here. And that is for the last take profit, which is the 4.618 fib. So all of these 618 fibs are very important. The price just seems to love anything that's 618, okay? So now that we filled it out, we can see that from the $1,000 investment, it's yielded $37,000 in terms of returns. So it's best used as a guide really, and it's best used as a way to see what's possible and to serve as a reminder that's written down so that, because when in a market, what happens is during this stage of the market, in the doldrums, everybody's thinking, how amazing it would be if, VRA gets to 9 cents, I'll sell everything and I'll be able to buy this and buy that and buy this. But unless people write it down, by the time the price gets to that level, people forget. And people are made to forget by all the people on YouTube and on Twitter who say things like, it will go up to $1. And they think, I can't sell now because it will go to $1. But if you have a Mooncalc, if you have a take profit plan that you can refer to and you can see how much you could potentially make, then that can help to aid your decision. And you can really play around with this. You can play around with the budget. If we change the budget, it changes everything here. So it will basically just increase. Well, we'll need to change the holdings first. So once you've changed the budget, copy the quantity and you paste it into the holdings. And you can see that it's just tripled everything. So it's a really good way to get an idea of the potential of the assets that you're holding. And this is this doesn't just work well as a calculator, it also works well as a log. So once you fill this out for VRA, you can simply right click on it and duplicate it and you make a new one, okay? And what I like to do is I like to name these tabs. So this one is VRA. And if I go on here, say I want to do it with, PGX, for instance. Okay. I'll just go on here and then I'll delete all of this stuff and I'll make a new one for PGX. So it's a calculator and a record that you can look back on, and you can use this to set your limit sell orders during the next bull run. In crypto, as with all markets, being able to identify a possible trend change early before it happens is key to making, and more importantly, keeping big gains. In every market, there are 4 main phases to the market cycle. These are the accumulation phase, the markup phase, the distribution phase, and the markdown phase. Each market cycle goes through several phases. In the beginning, there's the accumulation phase, where the market spends a period of time going sideways, giving savvy investors plenty of time to slowly and steadily accumulate as many coins as they want. Then there's the markup phase, where the market begins to trend upwards. During this phase, all news surrounding the coin is positive, and buyers start to flood in. Price goes increasingly vertical and gets further and further above the 50-week moving average. The distribution phase, or blow off top, ends the markup phase as sellers step in as they start reducing their exposure to the market. Sell volume increases whilst buy volume declines. The final phase is the markdown phase. In this phase, the price starts to fall. It happens slowly at first, then gathers momentum as fear builds and holders capitulate in order to avoid further losses. This is the stage where Bitcoin crashes down below the 50-week moving average. Unfortunately, this is where most investors find themselves selling, which is one of the worst times to be a seller. As a savvy investor, you'll want to make sure that you do all of your selling in the distribution phase. Here are 2 ways that you can identify when the distribution phase is about to end, which signals the end of the bull market and the beginning of the bear market. 1. Look at what Bitcoin does. 2. Calculate the length of time since the last Bitcoin halving. As of 2022, the crypto market is still dominated by Bitcoin, which is currently the largest crypto by market cap. Whilst this may change in the future, for now at least, Bitcoin runs the show and sets the pace for the rest of the market. Bitcoin and the 50 and 200 period moving averages. If we look at Bitcoin's price history on a 3-day chart, we can see that it's generally in a bull market when the price is both above the 50 and 200 period moving averages. When Bitcoin's price dips below the 50 period moving average, then that should be seen as a warning signal that the bear market could be approaching soon. When the price eventually goes below the 200 period moving average on the 3-day chart, that should be seen as a confirmation that Bitcoin is in a bear market. Ideally, you should have done all your selling before Bitcoin's price goes below this level, especially if it's been above it for over a year. How long has it been since the Bitcoin halving? The Bitcoin halving occurs roughly every 4 years. During this event, the supply of new Bitcoins rewarded to miners every 10 minutes gets cut in half. The last Bitcoin halving occurred on May 11, 2020, when the mining reward was reduced from 12.5 to 6.25 every 10 minutes. Currently, the next Bitcoin halving is scheduled to happen around April 1st, 2024, when the supply will drop to 3.125 new Bitcoins every 10 minutes. Looking at the past 3 bull cycles, we can see a clear pattern. Bull runs typically end between 12 and 18 months after the Bitcoin halving. The first Bitcoin halving occurred on November 28, 2012. Bitcoin peaked just 12 months later in November 2013. The second Bitcoin halving occurred on July 9, 2016. Bitcoin and the entire crypto market peaked 18 months later in mid-January 2018. The third Bitcoin halving occurred on May 11, 2020. Bitcoin peaked 18 months later in mid-November 2021. The altcoin market peaked a few weeks later. By using these 2 methods of market identification, you can get a rough idea of when the bull market is about to come to an end, so that you can make the necessary preparations for the coming bear market. Being able to identify this before others will give you the advantage of being able to sell easily at prices that are attractive to you. There will be plenty of eager buyers who will be happy to buy from you in the remaining frantic months and weeks of the bull market. You did it. Well done. Congratulations for completing this course. The time you've dedicated towards focused trading and investing education puts you ahead of 99% of crypto investors. There are many pitfalls on the road to profitability, but as with anything worth pursuing in life, perseverance really pays off. The journey of a crypto investor can be quite challenging at times, as the highs and lows of the market can make the path to profitability just as volatile as any crypto chart. I hope that this course will help make your journey to success a little less volatile, as you continue on your own unique path towards being a consistently profitable crypto trader and investor. If you'd like to stay updated with everything that's going on in the crypto space and continue your crypto education, please check out my Linktree, where you'll find links to all my social media pages. Thank you for taking the time and effort to complete this course. I wish you great success as you continue on your crypto journey.